What's up, everybody, and welcome to another episode of Millennial Minds in Business, where we sit down and we talk to young entrepreneurs who are changing the landscape of business as we know it. I'm your host, Stephen Gabrielson, with SLG Advising, business consulting of the new age, and I am lucky enough to be sitting across the desk here from Sean West. And Sean West, over the past 11 years, has built a successful financial advising practice here in Meridian, Idaho. At the age of 14, Sean received a gift of stock from his great uncle Merlin, and he also got a personal finance book from his uncle Sam. These two gifts started his journey into financial advising. Sean started his financial advising practice in 2007 and has led clients through the ups and downs of the economic and market cycles over the last 11 years. Sean is a certified financial planner, or also known as a CFP, and serving over 180 clients across the country. He and his wife and 4 wonderful children. Sean likes to spend his free time serving in the community and enjoying the outdoors with his family. So Sean, welcome to the show. Thanks for being here. As we dive into stuff, go ahead and tell us a little bit about yourself and what you got going on.
Awesome. Well, thanks, Steve, for inviting me to do this with you. I'm really excited to be here, so appreciate this opportunity.
It's fun having you. And to also let everybody know, this is our first Instagram Live that we have going on for the podcast, as well as the first ever films. We got cameras all over the place. So this is fun. I'm excited.
Yeah, this is the real deal.
Yeah, we're going to have a very in-depth discussion about the stock market and why it's so important to invest. So I'm excited. But before we jump into that, tell us a little bit about yourself.
I love what I do. So, part of the story you shared with my 2 uncles who changed my world.
Yeah.
It started out at a young age. I come home from high school, look at the ticker tape, see which companies went up the most, which ones went down the most, and just learned to really love the stock market itself.
Yeah.
It just fascinated me. And, from college, I was thinking about being an attorney, and the good news is I had an older brother who asked me, what are you passionate about? And that's when I figured out what I wanted to do. And I wanted to be an investor. I wanted to be an advisor.
So the attorney didn't hold up.
The attorney didn't hold up. No. I chose a different path.
Well, good.
Yeah.
Seems like you chose the right path because you got some pretty cool stuff going on.
Yeah, it was the right path for me.
Yeah.
So
tell us about where you're at now, what business you're working with, and what you see happening in the next year or so.
Okay. I am currently with Quarterly & Parkinson Wealth Management. We are an affiliate of LPL Financial, who is our broker-dealer, an independent firm.
Cool.
And as you said in the introduction, I've got several clients that I work with across the country. A lot of them are here in the Boise area. But yeah, what I do is I do financial planning. So I look at clients' whole financial picture, try to understand not only what their goals are, more importantly what their values are, what they value in life. So that could be their kids, going on vacations, what they do at work.
Yeah.
Understanding what their passions are, and then helping them make decisions that lead to fulfilling those passions and those dreams.
Awesome.
Yeah.
So you work with a variety of different people.
Yeah.
Across the country.
Absolutely.
Old, young, middle-aged.
Yep.
Doesn't matter.
Doesn't matter. Most of my clients are middle-aged and older.
Okay.
I've got a few clients that are my age and have kids my age,
Cool.
and that kind of thing. But as it happened, that's just kind of who I ran into when I was building my business.
For sure. Well, cool.
A little bit older, yeah.
Well, awesome. So, should we dive into the topic at hand?
Sure.
So, what we're going to be talking about today, and for those of you on Instagram Live, please feel free to reach out with any questions that you may have as we go throughout the stuff. But I was listening to the radio a couple weeks ago, and there was a local guy here in the valley, I think. I'm not really fully sure on where it came from or who it was talking, but it sounded like it was a guy that was trying to push a lot of annuity type investments, whole life insurance policy type stuff. And he told everybody that was listening to look up an article that was written by the Wall Street Journal. And the article is titled 10 Stock Market Myths That Just Won't Die. And so I looked up the article, And I figured you would be the best person to sit down and kind of dissect this article and go through each one of the myths and talk about them. And not to say that some of these may not be true. There might be some in here that are true. But it's good to at least understand the context behind what we're talking about and what each one of these myths are. Because there's just a very short blurb on each one. So let's dive in. You ready?
I'm ready. Yeah.
All right. So myth number one is, or first off, back up. So the article kind of goes into it and it says, at times like this, your broker or financial advisor may offer words of wisdom or advice. There are standard calming phrases that you will hear over and over again. And so these phrases that we're going to go through are kind of the myths that he's talking about that just won't die. And so each one of these is a phrase that one would hear from a financial advisor or broker. And so the first phrase that we're going to be talking about is, this is a good time to invest in the stock market. And he also goes on to say in that paragraph he says, or as someone once said, asking a broker if this is a good time to invest in the stock market is like asking your barber if you need a haircut. So, I'm going to pass the ball to you. What do you think?
So, first off, that word calming, that's a huge difference between a good advisor and a bad one. A bad advisor uses fear to get you to buy things that otherwise aren't in your best interest. So a good advisor is somebody who uses that calming influence to help you stay in the game and make better long-term financial decisions. Because when it comes to investing, emotions really are the number one factor that determine your behavior. And if you can keep your emotions in check, you're going to have really, really good results. So back to this first question, this is a good time to invest in the stock market. When you're accumulating assets, in all reality, you kind of want the stock market to be really, really volatile, because that's why you get better returns in the stock market versus other avenues out there, because it is volatile and there's a lot of emotion in it. So you get paid a premium to invest there. So I guess the thing that I would say in response to that, this is a good time to invest in the stock market. I think it certainly is, especially if you're a millennial. If we're talking to millennials here, it's a phenomenal time to invest. We've got 50 years ahead of us before we're dead, and there's going to be great opportunities that are going to come our way by investing in great companies of the future.
For sure, and I know we're going to get into this more as we talk and as we go throughout this article, but the stock market's kind of going crazy the past month, and it's put a lot of fear into people. Obviously, 6 months ago it was raging and roaring and everybody was loving it. And now it's kind of seems like it's flipped and it's opposite. It still has its ups and downs, but is there really a good time to invest in the stock market?
Yeah. Any day that ends in Y.
Any day that ends in Y.
Yeah. So
why is really any day a good day to invest in the stock market?
Because it's an investment vehicle for the long term.
Yeah.
So it's not something you're going to use to take care of a car purchase you're going to make next year, or you're going to try to pay off the debt that you have, and you're going to try to do it faster by investing in the stock market. That's probably not a good idea.
Yeah.
But using it as a vehicle to help you get from point A to point B to a goal that might be 15, 20, 30 years down the road, it's a great vehicle to use.
For sure. Cool. Well, let's jump on to the next phrase that people often hear, and it's actually fits kind of perfectly with, I think, what we're talking about within the good times to invest. And it's stocks on average make you about 10% a year. And he also goes on to say that experts suggest 5% may be more typical, and stocks only produce average returns if you buy them at average valuations.
Okay. Those are valid points, especially that last sentence, and stocks only produce average returns if you buy them at average valuations. What is an average return, and is that statement true, that stocks on average make you about 10% a year? To be brutally honest, the answer is yes. if I brought this little book, the Matrix book that has all this data in it. I'm just gonna give you some numbers from.
We're nerding out here.
We're nerding out. This is some numbers all the way back to 1926 on the S&P 500. So
Okay.
what is that? That is an index of 500 of the biggest companies in the United States,
Okay.
and it's their results for a long period of time.
So what are the other major ones that we follow here in the U.S.?
A lot of
For the
people
most part.
refer to this stock market as the Dow Jones, and
Which
that's
is
30 big companies.
okay. So it's basically the 30 biggest market caps within the U.S.
Yes.
Okay.
And then we've got the NASDAQ. A lot of tech companies are inside of that. That's got thousands of companies. The difference between it and the New York Stock Exchange is that it's a virtual stock exchange. It's done over the internet.
Okay.
So there's a lot of companies that are trading on. We won't nerd into all that that stuff.
Yeah,
but
for sure.
the S&P 500, the Dow Jones are typically referred to as the market, and
Okay.
I think the S&P 500 is a better indicator of what actually happens here in the United States. It's 500 companies versus 30.
Okay.
So just to give you an idea, from 1926 until now, or I guess the end of last year, the results of the S&P 500 was 10.2%.
And that's over how many years? Sorry.
That's over 111 years.
Okay.
Yep. Excuse me, no, I lied. 91 years.
91 years.
Yep.
You should be. I should be able to do the math in my head. I can't.
Yeah,
Like
yeah.
Calculators,
It's the cameras.
It's the cameras.
So, at any rate, back to his comment about, if you buy it at average times, you're going to get, average value, average valuations, you're going to get average results. Well, the average results are 10.
Yeah.
So, when you look back to, if you were to look at the bottom of this chart, I'm just going to go to 1960 just to get a little closer. 10.1% was the average till now. 1970, 10.5. 1980, 11.8. 1990, 9.8. And then 2000 till now, 5.4. So that one's a little out of character.
Mm-hmm.
And then 2010 till now, 13.9.
Okay.
Interestingly enough, this article that was written, that this advisor must have said something about on the radio, that he referred to, this actually was written in 2010. So if you had taken this advice or gotten scared out of the market because of fear during this time,
Yeah.
13.9% is what you missed out on.
Yeah. And that's the crazy thing that I kept falling back on when I was reading this article was this guy that I was listening to 2 weeks ago referred me to an article that was written in 2010, almost over 8 years ago.
Yeah.
To today. And so it's just crazy. So much has happened since then. And I think a lot of what you were saying is this article is based on fear, still playing on those feelings from 2008 and 9, where everything kind of went to hell in a handbasket for those involved in the stock market. So, yeah, that's interesting.
Yep. Yeah, I didn't catch that till about 5 in the morning when I was reading this morning. I thought, man, this is written
Yeah, isn't that crazy?
8 years ago.
Isn't that crazy?
Yep.
Cool. That was great. So our third phrase that you'll often hear from your broker or financial advisor is our economists are forecasting blank. So, and he also goes on to say that the record for economic forecast is not impressive, which I think everybody knows. Maybe not everybody, but and then it even says that even into 2008, many economists were still denying that a recession was on the way. So let's dive into that one. How do you handle forecasting when it comes to the stock market?
I don't.
Yeah. Do you even believe in accurate forecasting when it comes to the stock market?
I don't believe in that. There's two schools of thoughts when it comes to investing. There's fundamental investors, which look at a lot of data and they decide on which companies to buy because of certain information in their statistics and their financials. And then you've got technical investors that look at charts. So they would disagree with me on this. on forecasting, but technical investors believe that they can forecast, or they can kind of see into the future of what's going to happen with this particular investment. I fall into the latter category of fundamental investing. I believe in long-term stuff. So what I do is boring, and I don't really believe in forecasting. I don't believe it works.
Yeah. You know what I mean?
So I agree with them on this point.
Yeah. That economic forecasting is kind of for the birds, man.
Yeah.
No one
Absolutely.
knows what's going to happen in the stock market tomorrow. Not even if you're an owner of one of the top 30 Dow Jones companies.
Absolutely.
No one knows. No one knows.
Right.
So I think we can say that one is relatively accurate and relatively true, right?
Agreed.
I'm just going to mark this so that we can recap what we think
Yeah.
at the end here. So let's see. Jumping into our fourth phrase is investing in the stock market lets you participate in the growth of the economy.
Awesome. So I changed the last word in that sentence to, instead of economy, company. So investing in the stock market lets you participate in the growth of the company.
Okay.
And that's really the truth. You know, when it comes to an economy, in his paragraph he references Japan, and he references the tough times they've gone through since the late 1980s. And it's true, they've struggled. If you invest in a company that's either in Japan or in the United States, you're going to get the results of that company.
Yeah.
So I wouldn't necessarily latch on to that statement of investing in the stock market lets you participate in the growth of the economy. I don't think the growth of the economy really determines what
reflected
your investments do.
Yeah. And another thing that I think a lot of people miss is the direct performance of a company doesn't necessarily reflect the stock price. For example, every quarter or every year, these companies will come out to the street or Wall Street and give a forecast of what they think is going to happen over the next quarter and so on and so forth, right? Mm-hmm. And a lot of times that stock price is based off those forecasts and how close they get to hitting those forecasts, right?
Right.
And so you can have a company that forecasts to make $500 billion this quarter, and if they only make $300 billion, they still make a lot of money, but they were way off on their forecasts,
Right.
and that can actually hurt their stock price.
Right.
Right. So even if these companies are growing and doing a lot, and the economy's growing with them, stock prices can be hurt from botched forecasts, basically. Right.
Missing their expectations. Yeah.
Yeah. So, are we going to say that was true? In a way.
We're going to say it's true in a way that, if you invest in the stock market, you're going to participate in the growth of the companies in which you invest.
Okay. I like that. I like that saying. That was well put. Very well put, Sean. All right, so let's jump into our fifth phrase that you'll hear from your broker. And that phrase is, if you want to earn higher returns, you have to take more risk.
Love it.
Love it. Higher risk, higher returns.
Love it. Couldn't have been stated any clearer. The word risk. The word risk is just abused in our industry, and it's abused outside of our industry. When people look at the stock market, or they look at the bond market, the real estate market, whatever it is, there's a risk.
Yeah.
I mean, there's a risk if you step outside your door every day.
Walking down the sidewalk,
Right.
There's risk.
So the real question is how do you define risk? And really, if you're defining risk as the volatility of the stock market and how that's going to hurt you, you're probably looking at it the wrong way.
Yeah.
Okay. I think that's a risk, but I think that the bigger risk for most people is the fact that back in 1980, the price of a stamp to send something in the mail, it was 15 cents.
Wow.
So the Miracle on Ice, you could have bought one of those. Like, I wish I had the internet to show you.
Uh-huh.
But the postage stamp back then, the coolest one was this hockey guy. That was the Miracle on Ice. That was the year that the United States young guys beat the Soviets in the World Cup, right? So, at any rate, that stamp cost you 15 cents. Well, fast forward to 2010 when this article was written, 45 cents to send something in the mail.
Yep.
Today, what is it?
It's still around 49, isn't it? 49 something.
49.50. And I just heard a client tell me yesterday, she said, I just heard that the price is going to 55 cents.
Woo! See, the funny thing is most of our listeners, millennials, none of us know what the price of a postage stamp is because none of us send snail mail anymore.
That's true.
That's the craziest thing.
That's
We just
true.
go, if we have to send something that's big enough, we go to the UPS store, put it in a box, and ship it. We don't even care what the shipping rate is.
Right.
But I like where you're going with this, so keep going.
Yeah, so I guess I'm using the wrong example for millennials. But at any rate, 30 years from now or 25 years from now, instead of being 55 cents to send something in the mail, it's going to be $1.50, $1.60. And that's just the reality of the risk we face.
Yep.
Anybody faces that risk. And that risk to me is 20 times greater than the risk of the stock market dropping by 2,000 points tomorrow.
Yeah. And oh my gosh, I also think another big
Speaking
thing.
of the Dow.
Yeah. I also think another big thing that this doesn't really touch on is long-term versus short-term. And that play on the word risk, right? If your play is short-term in the stock market, your risk is a lot higher because of the volatility within the stock market because it's naturally volatile.
Mm-hmm.
But those long-term plays, like we talked about earlier, with the average of 10% growth, there's not much risk there because we have the data that shows 10% growth on average year over year.
Right.
So
taking that a step further, we can talk about different assets and asset classes. So there's a higher level of volatility or risk, you could use that word,
yeah,
to invest in smaller or medium-sized companies versus large ones. Over the long run, those small and medium-sized companies will have better results than large companies over the long run.
yeah,
So you could say in the short run, there's more risk to them, but in the long run, there's less risk to them because they earn more money.
Yep.
Right? So I think your point of looking at the short term versus the long term is the key to understanding that word of risk.
yeah,
And when it comes down to it, there's really two types of safety. There is, and when we're talking about financial stuff, there's statement safety and then there's spending safety. Statement safety is provided by things like CDs and savings accounts and treasury bonds.
which generally hold a lot less growth.
Correct. So there, on those types of investments, right now you're going to get 2 to 3% on your money, which is fantastic. 2 years ago, guess what you'd have gotten?
Yeah, like
Nada.
Yeah,
Zero zip. Okay?
yeah,
So talk about risk. If you had all of your money and you were retired and you had it invested in CDs and treasury bonds, and you went from 2007 when you could have gotten 5% on your money to 2016, 15, 14, 13, 11, and you'd have gotten 0 on your money, that's a lot of risk.
yeah.
Okay, so
Especially with the growth that was taking place in the stock market during that time.
correct. So the thing that they do provide to you, however, is statement safety. Okay, when you get your statement, you look at it, it was like, oh, that was $100,000 last month. It's $100,000 this month. I have my statement safety.
Yeah,
But really what stocks provide to you, and even real estate, things that are ownership investments, they provide long-term stability, long-term safety. And that's why we own them.
okay. That leads us to number 6. So the 6th phrase that is a myth that will not die, of something you would hear from your broker or financial advisor, is the market's really cheap right now. The PE ratio is only about 13.
So back in 2010, I would say that phrase was spot on.
Really?
Yeah. That's when the markets were really cheap.
Yeah.
Okay, that's when the price to earnings ratio was. I mean, I don't have the data right in front of me, but it was probably close to that number.
Yeah.
Today, I wouldn't say that to somebody.
Okay.
Okay, I wouldn't.
And that's because of the enormous amount of growth we've seen over the past 2 years.
Yeah, because the prices of companies compared to what they're earning right now is different than that. It's
Yeah.
higher. It's in the 20s.
So
if you look at the Shiller PE, it's in the high 20s, 29.
Yeah.
We won't get into that, but that's so. I will say that I would not say that right now.
Okay. So talk to us a little bit about the mechanics of the PE ratio. So what is a high ratio? What's a low ratio? What is a good time to sit back and think this is a good price to earnings ratio?
Well, if you read an article and it says price to earnings ratio about 13, back up the truck. Okay, load up. Because that's a really good valuation.
Okay.
Back in 2009, the valuations were in the high single digits, like 8 and 9%, or not price of a company compared to what it earns. So what that ratio is it looks at what a company's stock price is at. Let's just say it's at $300, and it's making $3 a year in earnings. It's priced at 100 times earnings. That's really, really high.
Yeah.
And a company that's a high growth company, like Amazon, for example, would have a valuation like that. And it doesn't mean that it's overpriced.
Yeah.
It's just priced that high because it's growing really, really, really fast.
And people love the stock.
Right. So you can't compare an Amazon to a Republic Services or Waste Management that picks up your trash.
Yeah.
Okay, they're entirely separate companies, and they're going to have entirely separate price to earnings ratios.
Yeah.
So typically, the lower that ratio, the cheaper something is.
Yeah.
But I guess you can't blanket all investments out there and say, oh, everything's at a 13, it's good.
Yeah.
You have to look at things on an individual basis.
And does that kind of vary even between like industries? So like a tech industry versus more of a utility?
Yeah, tech industries are typically going to have higher PE ratios versus utilities are going to have lower PE ratios.
Okay, so it's not necessarily looking into a PE ratio and saying, oh, 13, I need to go buy that. Correct. It's more of looking at the entire industry, see what the industry's trending at versus those ratios, and then making a determination if it's a good investment or not.
Yeah.
Okay, so, we didn't even mark it. We got to go back to our fifth one about risk. Did you say that one was true or not? We said it was maybe
It's a completely retarded saying.
Yeah. Right? So it's basically a play on the word risk.
Yeah. We could write that same thing about investing in CDs, or if you invest your money with a guy who was using fear on the radio and you buy an annuity that's a fixed annuity at 5%, you have quote unquote zero risk. But no, in all reality, you've got a ton of risk.
Yeah.
Okay, so it all depends on how you define risk.
Okay.
So I would say that statement is a bunch of baloney and it's false.
Okay. All right. So the PE ratio about 13. The statement itself, the market's really cheap, PE ratio about 13, is actually a true statement. That is a cheap PE ratio.
Yeah.
But you gotta take it in context, right?
Right.
All right. So our next phrase is you can't time the market. And he goes on later to say, if you invest in shares when they're cheap compared to cash flows and assets, typically this happens when everybody is gloomy and down on the market, and you'll usually do very well, versus the opposite when you invest when shares are very expensive, such as when everybody else is absurdly bullish, meaning they're going after the stock market, you will probably do badly.
So I think from his two statements there, I think he's on. Okay, so if everybody in the world's fearing that like in the last 8 weeks, we've had a correction, things have gone down by 10% or more, right? That is, in the eyes of Warren Buffett, it's a great time to go buy it. Pull out the shopping cart, go buy something.
Yeah.
And when everybody's cheering and things are up, the highest they've ever been, it doesn't necessarily mean that's the time to sell it. But if you're a retiree and you've got to prepare for the next year's worth of income, it's not a bad time to, take some of your gains and throw them into your cash buckets that you use to provide you your retirement income.
Yeah. Cool. So basically, this also kind of goes back to what we were talking about earlier as well. You can't time the market is basically the same thing as saying this is a good time to invest in the stock market because they go kind of hand in hand, right? So, I like what you were saying with that.
And if you're a millennial, you don't need to time the market.
Yeah, you just got to basically you got to.
And you can't. Let me tell you that I agree with those words. You can't time the market, but what you can do is you can accumulate and you can buy into the market on an average basis every single month when you put money into your account. That's the best way to invest.
Yeah.
And that way you take advantage of the volatility that the market offers you. And the volatility is your friend. It's not your enemy. Volatility helps you. That's how you get really good results long term, is because it is volatile.
Yeah. And so that is also, it sounds like it could be a play on the short term versus the long term investing as well.
Mm-hmm.
Right? If you're trying to time the market, generally means you're going more of a short term investment to pull it out once it grows, and you're playing that volatility, which I would say 98% of the time you're probably going to get bit pretty hard.
Yeah, you're going to get burned.
Over the history, we've seen how poor people are at doing that. But in the long term, if you're seeing 10% growth year over year on average in the S&P, then when does it matter when you jump in? Because it's going to grow that 10% year over year on average. So yeah, love it.
And
love
the key words there is on average. There's going to be some years where you get 30, and some years where you get negative 10, and then some years where you get 2 and 8. And, every number under 50 is going to get used. And maybe 50 sometimes will get used, but that's pretty normal to see that.
For sure. All right, so that jumps us into our next one. Our next phrase is, we recommend a diversified portfolio of mutual funds. That is a quote-unquote myth, according to this article, that you will hear from your broker or financial advisor. He goes on to say that a lot of brokers, within the term a diversified portfolio, means that investing in mutual funds with different names and styles, like large cap value or small cap growth, mid cap blend, international small cap value, and yada yada yada,
that they are marketing gimmicks. So that tells you right there that his understanding of the different asset classes is very minimal.
Really?
So the writer of the article, Brett Arends, doesn't really understand the difference between small cap value and small cap blend and small cap growth. He has no idea what those mean.
Yeah.
Okay, but they are different.
Yeah.
And those are different than large cap growth and then international value. All those things are different. So if you have a mutual fund that says those different things behind them, they are different.
Yeah.
Okay, it's not a marketing gimmick.
What are some of the differences between the two of them, or between the variety of them?
So, for example, in the small cap universe in the United States, there's 2,000 companies that's in the Russell 2000 index. Okay, and those are all smaller companies versus the 500 big guys that are in the S&P 500. Okay, so what is the difference between all of them? Well, they're just smaller companies that are up and coming companies that eventually some of those are going to break through to the next level and the next level after that and become very large companies.
Yeah.
Apple's a company that started out of a garage. At some point in the past, it was a small company. Now it's a monster.
Apple opened up. What was its price when it first came out? Wasn't it like 50-something cents? Was it that low, or was it a couple bucks?
I don't know.
And now
I should know that, but I don't know that.
Its high was what, $215, $220?
Yeah, and that's after it split. So it just split a few years ago.
Yeah.
And then it just got up into the 220, maybe in 230 a few weeks ago.
Jeez, crazy.
So back to what he wrote here, though. He says this: if your broker means you should diversify across things like cash, bonds, stocks, alternative strategies, commodities, and precious metals, then that's good advice. So back to his unintelligence of writing this article. Really, when you think about cash long term, it's not going to make you hardly any money at all.
Yeah.
And then precious metals, they can be a hedge and try to protect on the downside, perhaps, if you're buying gold. But when you look at the long-term history of metals and what they do for you as an investor, very bad long-term investment. So metals are a trade, they're not an investment. So the fact that he says, if your broker's telling you to buy that, this, and you're mixing things up, it's like, well, he's telling you to buy stuff that's not going to do good long term.
Yeah.
If he's telling you to buy that for a trade or to hedge against the downside, perhaps, then he might be giving you some great advice. But if he's telling you to buy metals for the long run, he's not giving you good advice.
Yeah. So is there certain situations where a diversified portfolio among bonds and precious metals and stuff like that is a good idea? Generally, I what comes to mind for me, at least in my mind, is maybe someone who would walk into your office who's in their 50s or 60s and has a lump sum of cash they need to invest. Is there a better strategy out there than just doing stock market stuff?
Depends on how long you're talking and what kind of valuations things are at in the markets. Where do you, if there's a lot of fear out there, there's a lot of greed. You know, it just depends on this situation.
Yeah.
But if their risk tolerance tells you're sitting across the table from them and they're like, "Ooh, all we've ever had is CDs." I don't think it's, in my experience, you want to break them in slowly. So
going from like a CD investment or something that's very steady, very safe.
They've had statement safety their entire investment career.
You don't want to take that and dump it all 100% in the stock market.
Yeah, you want to prepare them for this is how this works, and here's the results, and you want to educate them on how everything works. And talk about volatility. Gold. That's one of the most volatile assets out there.
Yeah,
for
sure.
That's that goes without saying. So I think that the key there is just to understand yourself, make sure your advisor understands you, and then you'll have the right mix of assets.
Definitely. So jumping into our next our next phrase that you would often hear from your broker or financial advisor that may be a myth is this is a stock picker's market. So first off, walk us through what the heck a stock picker's market is. And yeah, let's dive into this one.
Okay. So a stock picker's market. It's kind of like when you hear the phrase, in real estate, this is a buyer's market or this is a seller's market. When they say that in real estate, it just means that there's either an oversupply of homes or a lower supply of homes. It just means it's a good time for one or the other.
Right.
People say that in the stock world. What that means is that active managers, people who go out and they selectively pick out 60 companies to invest your money in, they have a good market, right? Or that it's way more difficult. So at the bottom of the market in 2009, you could throw a dart and hit a bullseye almost every time.
Yeah.
Okay? Just pick XYZ company, put your money in it.
Everything was down.
Everything was down. Yep. So that's not a stock picker's market. Okay? In today's environment, when everything's come up to the highest levels ever, we got higher multiples or valuations. It's more of what we would call a stock picker's market. Okay, it's supposedly an opportunity for active managers to do better.
Yeah. Okay. So is there any validity in that phrase? Or is there?
That's the great debate.
Yeah.
So the great debate in our industry right now is whether or not active managers actually add value. So
walk us through what an active manager is.
So an active manager is a manager over in New York, Boston, San Francisco. She's got 10 to 50 analysts working for her. So analysts that go out and they're researching companies and they're bringing her back ideas. And she is deciding to take Joe's advice and Sam's advice and Esmeralda's advice. Okay, and those are the companies that she chooses to buy. That's an active manager. What's a passive manager? Passive manager says there's 500 companies in that index, we buy all 500. Or there's 2,000 companies in that index or 1,000 companies, we buy all of them. So passive managers have lower costs because they're just an index. They're just buying what's out there, and there's not a lot of people working to produce that result.
Yeah.
So the more people you have working to produce a particular result, the higher the costs of your mutual fund are going to be. So that's an important thing to consider. Will they, with all the things that they're doing to try to make you more money in your investment, will they make that extra money because of the things that they're doing?
Okay.
So I am on the school of thought that the answer to that is most of the time, no.
Okay.
Okay. I think in some instances, particularly with bond managers, I think they add value, and growth managers, I think, add value. Those are the two I'll single out in my own opinion.
Yeah.
But I think active managers in the value space and that kind of stuff, I don't think they add value.
And does that kind of go back to, where was it? You can't time the market.
In a sense, yeah.
In a sense.
Well, you can. So active managers, they can have a great run. So I've seen it where they will do really well for 10 years, maybe 15 years, and then everything blows up.
Yeah.
Okay, so it's very hard for them to repeat their success.
Okay.
So when it comes down to it, if you're a mutual fund manager or an advisor and you're picking mutual funds for your clients, what we're trained to do is look at Morningstar and see which mutual fund has 5 stars. 5 stars means they've kicked butt for 10 years.
Yeah.
And they're 5-star funds. So you're trained to put all of your clients' money in the 5-star funds. The problem with that strategy is that that's all that history, all those 5 stars came from past performance.
Yeah.
It doesn't mean that they're going to do it again.
Yeah.
That being said, there's some managers that still pull it off, but the percentages are low.
Yeah.
So I could give you those percentages in a minute if you really want them. If you guys are dying to have
they're
those.
low. We're talking like less than 10%, right? Is it lower than that?
No, I think it's higher than that. I think it's like I'd have to see the numbers, but I think it's like 15% if I remember.
Okay, but even then,
like 15% of the ones that did really well repeat themselves.
Yeah,
that's a really low.
That's low
number. Like out of all the actively managed funds that are out there, I think it's the numbers are like 50 to 60% of them get closed up, meaning that the mutual fund actually shuts down within 10 years.
Wow.
Because they just don't produce. They don't do what they're set out to do.
Wow.
And so out of the survivors of all that, there's only a few that are the winners, and then there's only a few that repeat themselves. Very few that repeat themselves. So
you're talking a handful of mutual funds that are actually going to be successful past year 15, 20, 25.
And there's a few that I believe in, right? But most of the things that I do, it's all passive.
Yeah. Okay. So that kind of squashes that one. Do you have anything else you want to say about the stockbrokers market?
No, that's good. It's just funny. It's funny that that's one of the myths he put in there.
Yeah.
But what's a myth about that? That's just a statement.
Yeah. All right. So the final phrase that could be a myth that you would hear from your broker or financial advisor is stocks outperform over the long run. And so he goes on to say, define the long term. If you can be down for 10 years, for 10 or more years, exactly how much help is that? As John Maynard Keynes, the economist, once said, in the long run, we are all dead.
Yeah. I love Brett's last point because that one, he just, the stocks outperform in the long run. It's so true.
Yeah.
They do.
Yeah.
And so I don't know how that's a myth. So the definition of a myth is a belief in something that's false. And I think it's a true statement. So what do we say to that?
I mean, well, we go back to the numbers.
There are a couple periods where you had negative returns over 10 years.
Yep.
But very few. I think I'd have to go make sure, but I think it's around 2.
Yeah. And so that's crazy to think. 2 of of all the historical data that we have, the stock market is really a play on statistics when it comes down to the nuts and bolts of it. And like we've been talking about, that long-term run is so important because the long-term average year over year, we see 10%. And so, I mean, this whole phrase, stock markets outperform over the long run, and how he's saying that's somehow a myth, is just kind of blows my mind, because all the information out there is completely contrary to that. So that kind of blows my mind.
Yeah. So I would ask the baby boomers, you're retired now, how long do you plan on living?
Yeah.
And most of them are going to say 20 to 30 years.
Yeah.
Well, that to me, that's long term.
Yeah.
And if you are invested in long-term assets over that time frame, you're going to win.
Yeah.
Versus the millennials, I ask you the same question. How long until you retire? They're going to say, what?
40 years, 30 years?
30, 40
You
years.
see how you have some aggressive ones that say 10,
Maybe
maybe 5.
Yeah, I'm going to retire in 5
I'm going to
years.
sell my app company.
And
It's
then
gonna make $10
the,
million.
the question behind that is, how long do you plan on living after that?
Yeah.
And then they can't hide from it, because
Yeah.
the answer to that question is, oh, well, I retire in 5 years, I'm going to live another 40 to 50 years.
Yeah.
And if doctors keep getting better and better, which they're awesome, we might live into our 120s. Who
Yeah.
knows?
That'd be cool.
Yeah.
I'm okay with that.
So that's long term to me. It's
Yeah.
long term.
Yeah, I mean, reading through that kind of summarizes all the phrases that were in this article. And I mean, going back and looking through them, this kind of cements my belief in the stock market and how important it is for young people and young individuals to take advantage of investing in the stock market. And it doesn't take much. You don't have to have $100,000 in order to invest in the stock market.
You don't. No, you can start with $50. People start like that all the time.
Yeah. And
The earlier you start,
the better. And that comes down to compounding interest.
Mm-hmm.
For those of you who don't know who compounding interest is, or what compounding interest is, it's just the growth year over year of something, and with interest involved. So if you have $10,000, it grows at 10%. The next year you have $11,000. The next year you have $12,100, $200, and so on and so forth. And so it's growth on top of growth on top of growth. And so obviously the longer you can have something in an investment that has a return, the more better off you're going to be in the long run. So I think our closing argument really is, this article seems like it was a lot more written for someone who is aggressive, short-term in the market, whereas they don't have necessarily a long-term focus. At least that's what I gather from reading this article.
I think really when you look at CNBC on the TV and you read the Wall Street Journal, they aren't written for long-term investors. They're written for short-term investors.
Yeah.
Because all the information is day to day, second by second. You know, here's the latest on this, and this. But in all reality, that doesn't impact a long-term investor. Long-term investors aren't impacted by what happens in the news. The news media, the Wall Street Journal, in this instance, Brett Arends, his job is to write an article that captures attention.
Right.
So they want to capture your attention.
Right.
And in times like what we've experienced in the last 8 weeks, where you have a lot more volatility in the stock market, it's a great time to capture people's attention.
For sure.
And that's really when they can dip into that emotion of fear or greed. If the markets are going crazy and it just can't stop going up,
Right.
great time to write an article and get some people to read it. And
Yeah.
that's their objective. So really they're there to sell advertising and get you to read the article. And the more people that read their article, the more money they get paid, the happier Wall Street Journal is.
Right.
That's the way it all works.
Right.
So,
and it also comes back to when I was listening to the radio a couple weeks ago, there was a very distinct reason why the man I was listening to was trying to persuade people out of the stock market. And that was to push him into annuities and other types of investments for him to also make money on the back end.
Right.
And so it's always good to do your research when it comes to anything within the financial industry, especially your investments. Research both sides. And don't let someone point you to an article and you go read the article and don't take it all at face value. Make sure you do your research. Make sure you look into it, and make sure that you are very comfortable with what you are about to do with your financial plan and your financial future.
Mm-hmm.
And I mean, like I always say, my personal favorite is the best time to plan for retirement was yesterday. To start planning for retirement was yesterday. So if you're not investing, if you're not planning for retirement, I highly suggest you start planning for retirement. Get out there, start looking for vehicles to put your money in to help you grow over the long run. And call this man that's sitting across the table from me, Sean West, who is by far the best financial advisor and certified financial planner that I have spoke with on these subjects, and really is one of a very small handful that I really trust for long term and taking care of people's financial situations. So with that, where can people find you, Sean?
They can find me on the internet, on LinkedIn,
Yeah.
or at our website, cpwealthmanagement.com.
Okay.
They can also call me, 208-795-5123.
And I'll post all your information in the bio as well.
Yeah. So real quick, just back
Yeah.
to one of the first things I said. If you hire me or don't hire me, my advice is to find someone that is a calming influence to you when it comes to investing. Don't seek after those that use fear to capture your attention and to sell you a product, because they're not good advisors.
And
Good.
products include, when we say products, we mean annuities and what else do we mean?
It could be hedge funds. It could be
Hedge funds.
anything that's going to protect you on the downside, or it's another way of saying that we're going to help you make less money over the long run, or we are going to help you not reach your financial goals because you're using us, right?
Right.
The good financial advisors will help you find the right vehicles for you to reach your goals, but they'll also be a calming influence to you as you invest over the years, because it's not easy. If it was easy, everyone would do it and everybody would be like Warren Buffett, right? But it's easier for him because he has an understanding of market cycles and how financial markets work. And so it's a no-brainer for him to do the opposite of what most people do. But he does it because he's calm and he understands investing. And you need to find an advisor who's calm and understands investing, and then you'll have great results.
And that's why they need to call you.
There you go.
For sure. Well, hey, Sean, thank you so much for taking the time to be here today.
Yeah, thanks for having me.
This was a value-packed podcast. So go back, watch the Instagram Live that we did if you haven't been following along. This is also filmed. It will be posted on YouTube, as well as LinkedIn and other social media pages. So it's super important to learn this stuff. Thanks for being here. Until next time.
Thanks, Steve.
Thanks, Sean.